You've probably heard this saying, don't just work for money, make money work back for you. It sounds simple, almost comforting. Like once you save a little, the money will clock in every morning and do the heavy lifting on your behalf. But here's the part people rarely say out loud. Money is a very picky employee. It doesn't really want to work unless you pay it well first. Compound growth looks magical from a distance, but when you zoom in on the numbers, the illusion fades fast. It doesn't matter how disciplined you are, how many books you've read, or how early you start, if one crucial thing is missing. And that thing is a solid amount of capital. Without it, compounding doesn't disappear, but it moves so slowly that it can feel pointless. Let me paint a picture for you. Jason was 25 years old. He lived carefully. Tight budget, no flashy lifestyle. He skipped fancy coffee, didn't upgrade his phone every year, and consistently set aside $150 every single month. No excuses. He did this for 10 years straight. A decade of discipline. When he finally logged into his account and checked the balance, he saw about $24,000. And he felt like he had failed. But here's the thing. Jason didn't mess up. He did exactly what everyone told him to do. He saved consistently. He stayed patient. He trusted compound growth. The problem wasn't his behavior. The problem was scale. He was trying to roll a snowball using a snowflake. Compounding doesn't reward willpower. It rewards weight. And it's brutal about it. It quietly punishes the undercapitalized long before it ever celebrates the wealthy. That's why so many people follow the rules for years and still feel stuck. At this point, you might be thinking, so is compounding a lie? Not at all. It's just honest. Almost cold. It follows physics, not motivation. And if you've ever wondered why wealthy people seem to multiply money faster, even when they start later than everyone else, that's exactly what we're unpacking today. And stick around, because toward the end of this video, I'll also share how to make compounding work even if you don't have much money right now. It's difficult, but it's not impossible. First, we need to talk about one of the biggest illusions in personal finance. The idea that starting early automatically guarantees wealth. You hear this advice everywhere. Start as young as possible and riches will follow. That statement is half true and half trap. Time absolutely matters. But time only becomes powerful when it partners with size. Imagine dropping a single raindrop onto a trampoline. Nothing really happens. No bounce. No movement. Now imagine throwing a bowling ball onto that same trampoline. The surface bends, stretches, and launches back upward. That's the difference capital makes. A large deposit actually deforms the growth curve. A tiny one barely leaves a dent. People love to bring up Warren Buffett as proof that starting early is everything. Yes, he bought his first stock at 11. But here's the detail that almost nobody emphasizes. Roughly 99% of his net worth was built after his 50th birthday. Time helped, but the real explosion happened once his capital reached critical mass. The curve didn't rise gently. It snapped upward. Let's put some real numbers on this. If you save $100 a month and earn a solid 10% annual return, after 20 years you'll have around $69,000. That's not financial freedom. That's a decent used hatchback. Reliable, respectable, but not life-changing. So compounding isn't just a waiting game. It's mainly a positioning game. Without actively working toward a large base, you're not really compounding. You're just decorating a savings account and hoping time will do something heroic. Now let's talk about what wealthy people do differently. Where most people drip feed $50 or $100 from each paycheck and hope it turns into something meaningful in 30 or 40 years, the wealthy tend to do the opposite. They drop lump sums. $20,000. $50,000. Sometimes far more. And by doing that, they effectively speedrun decades of growth in just a few years. This isn't luck. It's capital leverage. Think of investing like planting. One gardener plants a tiny seed in hopes. Another gardener transplants a mature tree. Both actions are technically planting, but only one produces fruit almost immediately. The second gardener doesn't have to wait half a lifetime to eat. This is why bonuses, business profits, inheritances, and even large tax refunds hit wealthy portfolios like high-octane fuel. They don't treat windfalls as spending money. They inject them early because they understand a simple truth. Time multiplies capital, not thrift. The bigger the chunk, the sooner the curve bends upward. Now let's look at the uncomfortable flip side. Many people do everything right on paper. They budget carefully. They skip vacations. They funnel $200 or $300 a month into retirement accounts for decades. And after 30 years, they end up with maybe $400,000 before taxes and inflation. That's respectable. No question. But it's not a golden parachute. And it costs them a lifetime. Meanwhile, asset managers collected fees every single month. Authors sold bestsellers preaching discipline and patience. And those royalties? They arrived as lump sums. Small investing isn't evil. But small investing alone can quietly trick you into believing progress is guaranteed, while actually delaying the breakthrough. That treadmill feeling, the sense that you're doing everything right but not moving forward, usually comes from compounding that's been starved of calories. A better question than how long will this take is how big can I go, and how soon? This is where high earners reveal a shortcut. A surgeon, a software engineer, a business owner might invest aggressively for just 5 to 10 years. They front-load six-figure amounts, then step back and let time finish the job. They know something most people don't want to hear. A $100,000 seed can do more in 10 years than a $100 monthly drip can do in 50. And no, this isn't only about being born rich. It's about sequencing. First, you build the skill set, the business, or the side project that creates capital momentum. Only after that does compounding become truly powerful. At that point, it's no longer a rescue plan. It's an amplifier. Ask yourself this. What skill, service, or product could realistically raise your income by 20% this year? That extra money isn't lifestyle money. It's weight. And weight is what your future needs. Building weight is step 1. Guarding it is step 2. And that's where we're going next. Once you've built some weight, the next rule is brutally simple. Do not lose it. Compounding collapses the moment the principal disappears. That's why Warren Buffett's famous rule, never lose money, isn't about fear. It's about math. He understands that protection is just as important as growth. The wealthy don't obsess over hitting home runs every year. They obsess over staying in the game. They insulate their capital using tax shelters, index funds, property, and diversified income streams. They're perfectly happy with steady 7% returns instead of chasing 25% one year followed by -15% the next. Why? Because a smooth climb compounds. A roller coaster resets the clock. Every dollar you protect is a worker that shows up again tomorrow. Every dollar you lose has to be rehired from scratch. As your stack grows, your job slowly changes. Early on, the focus is accumulation. Later, it becomes defense. Fees, inflation, taxes, and random risk quietly eat more wealth than bad stock picks ever will. That's why wealthy investors scrutinize expense ratios, structure ownership carefully, and diversify not for excitement but for survival. Compounding only works when the base remains intact. But here's something most people miss. One of the fastest compounding engines doesn't even live in the market. It lives in you. Skills compound faster than stocks when you keep stacking them. One new skill, learned deeply and applied correctly, can double your income in a single year. Think about persuasive writing, negotiation, sales, software development, or even high-level project management. These aren't hobbies. They're income multipliers. And when your income jumps, everything changes at once. Your investing capacity grows. Your margin of safety increases. Your ability to take calculated risks improves. That larger paycheck becomes seed capital, opportunity fund, and emergency buffer all rolled into one. Almost every self-made millionaire followed this path, even if they don't frame it this way. They compounded knowledge before they compounded dividends. They invested first in their ability to create value on demand. This is why, in some seasons, spending $500 on a laser-focused course can outperform putting that same $500 into an index fund. The index fund might earn you 7%. The skill might raise your earnings ceiling for the rest of your life. That's an annualized return Wall Street simply cannot compete with. Now let's layer on something even more powerful. Systems. Hard work has a ceiling. Systems don't. When you're paid only for hours worked, growth eventually caps out. There are only so many hours in a day, and energy fades. But when assets and processes earn while you sleep, compounding becomes a 24-hour operation. Think rental properties, automated e-commerce stores, royalty-based content, subscription apps, or even well-oiled service agencies. Different industries, same pattern. Build once, maintain occasionally, collect continuously. Yes, systems demand upfront effort. They're awkward at first. Clunky. Slow. It often feels easier to just trade time for money and move on. But once a system is running smoothly, every dollar it generates feeds directly into your capital base. And that base now needs fewer years to reach critical mass. This is where many people quit too early. They underestimate how uncomfortable the early phase of system building feels. But discomfort is usually a sign you're doing something scalable. Here's the uncomfortable truth. Most people never witness compounding's real fireworks because they're taught that patience is the only lever. They wait. They drip. They hope. And after 2 or 3 decades, they arrive at almost comfortable. Not desperate, but not free either. Compounding isn't broken. It's just honest. It only bends for bulk. If your base is thin, you're not compounding wealth. You're compounding frustration. So the goal needs to shift. Not just start early, but build heavy. That means cultivating skills that earn more. Launching micro-businesses that spin off cash. Negotiating raises instead of accepting defaults. Selling unused assets. Cutting subscriptions you forgot you even had. And most importantly, funneling windfalls instead of spending them. Every extra $1,000 today matters more than the same 1,000 10 years from now. Not because you're impatient, but because today's dollars get more compounding cycles. They get more time on the clock. Let's tie all of this together. Compounding only dazzles when there's a meaningful sum of money involved. And that sum is built faster when you deliberately leverage 3 engines. Skill stacking, system building, and strict capital protection. The game was never purely about time. It was always about size. The moment your capital crosses a certain threshold, growth stops crawling and starts sprinting. The curve bends. The math finally looks exciting. And from the outside, it seems like magic. Quiet, powerful, predictable magic. But you'll know better. You'll know it was never luck. It was math paired with momentum. If this message hits a nerve, that's a good thing. It means you're ready to trade slow, generic advice for intentional progress. That doesn't mean reckless moves or blind risk. Always assess your goals and your comfort level before jumping in. But whatever you do, don't drift. Use today to thicken your seed money. Sharpen a skill. Design a system. Protect what you've already built. Because once you reach critical mass, compounding finally starts to look like what everyone promised it would be. And in the next part, I'll walk you through how to actually apply this thinking when you don't have much money to start with, and what practical moves make the biggest difference early on. Just like compounding itself, the setup matters more than people think. Let's talk about the hardest scenario, because this is where most people tune out. What if you don't have a large sum of money right now? What if the idea of dropping $50,000 at once sounds completely unrealistic? This is where many financial conversations quietly end. But this is also where they should actually begin. If you're starting with little capital, your primary enemy isn't the market. It's distraction. When money is scarce, every decision carries more weight, and every mistake feels amplified. That's why the goal early on isn't to maximize returns. It's to maximize direction. You don't need perfect investments at this stage. You need momentum. Small amounts of money can still compound, but only if they're attached to something that grows your capacity. If all you do is drip $50 into an account each month and wait, you're asking time to do all the work. And time alone is a very slow partner when scale is missing. So the first move is simple, but not easy. Stop treating investing and earning as two separate worlds. They're deeply connected. Early on, your highest return asset is your ability to earn more next year than you earn this year. This means saying no to the idea that investing is something you do after work is done. Sometimes, the best investment is redirecting money and energy toward becoming more valuable in the market. Ask yourself a brutally honest question. If I had to double my income in the next 24 months, how would I do it? Not in theory. In reality. Would it be learning a technical skill? Moving into a higher paying niche? Starting a service business? Switching industries entirely? This isn't about hustle culture. It's about leverage. A single well-chosen skill can permanently shift your financial trajectory. And once your income rises, compounding finally has something to work with. While you're building that income engine, you still need to respect capital, even in small amounts. The habit of protection starts early. Avoid high-fee products. Be skeptical of complexity. Don't gamble disguised as investing. Losing $2,000 when you only have $5,000 isn't a lesson. It's a setback that steals years. Consistency matters here, but not in the way it's usually framed. The consistency that counts is consistent direction, not just consistent deposits. If your income is rising and your systems are improving, even modest contributions are doing meaningful work behind the scenes. Another overlooked lever is how you treat windfalls, no matter how small. Tax refunds. Side hustle income. Gifts. Bonuses. These are rare chances to inject weight into your capital base. Most people spend them because they feel temporary. Wealthy people invest them because they understand acceleration. One lump sum, even a small one, often does more than a year of tiny drips. Not because it's magical, but because it bends the curve earlier. Now let's address patience, because it still matters, just not in isolation. Patience without a plan is just waiting. Productive patience is staying focused while building capacity. It's choosing delayed gratification not because someone told you to, but because you understand the sequence. First wait. Then growth. Then time does what it does best. This also means redefining what success looks like in the early years. It's not portfolio size. It's income growth. Skill acquisition. System stability. Optionality. These are the quiet signals that you're moving toward critical mass, even if the account balance doesn't look impressive yet. And once you do cross the threshold, things feel different. Contributions start to matter more. Returns look meaningful. A good year in the market actually changes your trajectory instead of just padding numbers. This is when compounding finally earns its reputation. At that stage, your job shifts again. Less chasing, more steering. Less accumulation, more optimization. You're no longer asking, how do I start? You're asking, how do I protect and direct what I built? That's where tax efficiency, diversification, and long-term strategy dominate the conversation. Not because they're exciting, but because they preserve momentum. Remember, compounding only works if the base survives. So let's bring this full circle. Compounding was never a lie. It was just oversimplified. Time matters, yes. But size matters more. And size doesn't appear by accident. It's built intentionally through higher income, scalable systems, and disciplined protection. If you take nothing else from this video, take this. Stop obsessing over starting early and start obsessing over building heavy. Focus on thickening your seed money as fast as reasonably possible. Learn skills that pay. Create systems that scale. Defend your capital like it took years to earn, because it did. Once you reach critical mass, compounding stops feeling slow and starts feeling inevitable. Your money grows quietly, predictably, almost boringly. And from the outside, it looks like magic. But you'll know the truth. It was math. It was momentum. And it was patience applied at the right stage. And since you've made it all the way to this point in the video, there's a very strong statistical probability that you should subscribe to this channel and hit the like button for more content like this. Let me know in the comments what you're focusing on right now. Skills, systems, or capital. Or maybe all three. I'm Bean Capital. I'll see you in the next one. Thanks for watching.